Welcome to an exciting discussion on the recent events surrounding Alibaba, a multinational conglomerate specializing in e-commerce, technology, and various other sectors. Today, we're diving headfirst into the turbulence that's been shaking up this tech giant's world. Let's rewind a bit. Jack Ma, the co-founder of Alibaba, has been keeping a low profile since the regulatory crackdown on his business empire in 2020. But recently, he's re-emerged, making an unexpected appearance on Alibaba's internal forums. His message? A call for change within the company, and a rare criticism of its performance. This reappearance is noteworthy. Ma has traditionally been the face of Alibaba, and his disappearance following the regulatory crackdown left a noticeable void. His return, coupled with his critique of the company's performance, signals a potential shift in Alibaba's strategy and culture. His reappearance wasn't the only surprise. He also took the opportunity to congratulate Pinduoduo, Alibaba's rival, on its strategic decisions. Now, this is interesting because Alibaba's current market cap sits at around $190 billion, while Pinduoduo's is hot on its heels at $183 billion. But what does this all mean for Alibaba? Well, Jack Ma's disappearance and reappearance have undoubtedly had an impact on the company's performance. His critique of the company's current state has added an extra layer of complexity to the situation. In summary, Jack Ma's unexpected reappearance and his critique of Alibaba's performance have set the stage for a potential shift in the company's strategy. Stay tuned as we dive deeper into Alibaba's recent performance. Let us now delve into Alibaba's recent performance, marked by a few unexpected turns and twists. Alibaba Group Holding Limited, also known as BABA, has seen some interesting developments in its two main segments, cloud and e-commerce. In the cloud segment, Alibaba had planned a spin-off. However, due to trade restrictions on NVIDIA's AI chips, this plan had to be put on hold. Despite this setback, it's important to note that Alibaba remains a strong player in the industry. In fact, it holds the position of China's largest cloud provider, commanding a market share of 34%. Shifting gears to the e-commerce segment, Alibaba's fiscal second quarter of 2024 didn't quite hit the expected top-line revenues. This miss led to a noticeable decline in the company's stock prices, a development that understandably raised eyebrows and concerns among investors and industry watchers. But it's not all doom and gloom. While the company did face challenges, it also made significant strides in cost optimization. These efforts resulted in an expansion of their adjusted earnings before interest, taxes, amortization, and adjusted earnings per share. These financial metrics are key indicators of a company's profitability and efficiency, so this improvement certainly shines a positive light on Alibaba's operational prowess. Despite the setbacks, Alibaba's cost optimizations have led to some positive outcomes, showcasing the company's resilience. But what does this mean for potential investors? For those pondering the idea of investing in Alibaba, this segment will provide some useful insights. If we take a close look at Alibaba's current financial situation, it's clear that the company's valuations are relatively cheap compared to its industry peers. This might seem surprising at first, given the company's dominant position in both the cloud and e-commerce segments. However, it's important to keep in mind that Alibaba's lower valuation also reflects the company's recent challenges, including regulatory scrutiny and slower than expected growth. Despite these headwinds, Alibaba is still expected to generate robust growth in both its top and bottom lines. The company's net cash position also continues to expand, which is a positive sign for any potential investor. This financial strength could provide Alibaba with the flexibility it needs to navigate through current challenges and invest in future growth opportunities. However, it's important to note that investing in Alibaba is not without risks. Particularly, there are risks associated with Chinese American Depository Receipts, or ADRs. These are securities that represent shares in a foreign company and are traded on U.S. stock exchanges. The risks associated with Chinese ADRs include regulatory, political, and economic risks that can impact the value of the ADRs and the underlying company. It's therefore crucial to understand these risks before deciding to invest in Alibaba or any other Chinese ADR. Despite these risks, the author of a recent article on Seeking Alpha maintains a buy rating for Alibaba. This suggests that the author believes the potential rewards of investing in Alibaba outweigh the risks. The author's bullish stance on Alibaba is based on the company's strong market position, its robust growth prospects, and its attractive valuation. Even amidst the storm, Alibaba appears to present a promising investment opportunity. However, as with any investment, potential risks must be taken into account. To wrap up, Alibaba's recent events have certainly stirred the waters, but the company's resilience and potential growth prospects make it an interesting player to watch. The return of Jack Ma and his constructive critique of the company's performance has added a new dynamic to the narrative. Despite a dip in top-line revenues, Alibaba's cost optimizations have resulted in expanded adjusted EBITDA and EPS. This, coupled with its position as China's largest cloud provider, points toward promising growth potential. However, it's important to remember the risks associated with Chinese ADRs. Thank you for joining us in this insightful discussion on Alibaba. Don't forget to subscribe for more updates on the latest business trends. Until next time, stay informed and stay savvy.